Hello and welcome to the Leaky Bucket podcast. I'm your host, Ian Morgan, and I'm here to make accounting fun and practical. With over 15 years of experience as an accountant and a business owner, I'm excited to share tips and tricks that will help you improve your financial controls and gain the clarity that you need to succeed. So let's plug those financial leaks and take your business to the next level. Stay tuned for some great insights. Hey everybody, and welcome to this episode all about optimizing your business structure for tax efficiency. So choosing the right business structure is crucial, not just for operational efficiency, but also for tax purposes. Today, I'm going to take you through the options available and see how they stack up against each other in terms of the tax efficiency. So first things first, we have the sole trader, sole proprietorship, self-employed. All of those mean the same thing, okay? It is the simplest and most straightforward business structure. It's usually the one that most people start out with because of the fact that it is so simple, and it usually has the best tax rates when you're just starting out, particularly if your income's going to be much lower, so certainly well below £50,000. As a sole trader, you and your business are legally the same entity, right? So if it was me, I would just be Ian Morgan trading as my business name. And it's purely just me operating, right? You'll probably still need a business bank account, but it's going to be effectively in your own name, trading as your business name. Now, the pros here are absolute simplicity. It's really, really easy and inexpensive to set up, and you have complete control over the business. You don't have to worry about, complexities of shares and shareholder agreements and all of those bits. It's literally get yourself started, and you're going to be taxed based on your profits that are on paper, okay? You don't have to worry about how much money you're effectively taking out of the business in that respect, because the business money is your money. Okay. Now, there are some cons here. You have unlimited liability. You are going to be personally liable for all business debts. Okay. So, not that everyone can do it, but don't go racking up loads of debts and think, oh, that's it, but it's business debt, it's not mine. That's not how this is going to work. Also, you're going to pay income tax on all of your profits. This can be less efficient as your earnings start to increase. Okay, so you do need to be aware of that. So for sole traders, profits are taxed at the income tax rates, and they go up to 45% for high earners. Additionally, as well, right, you're going to be subject to Class 2 and Class 4 national insurance contributions. This will work really, really well if your profits are relatively low. But as your business grows, and your profits certainly as they start to exceed £50,000 a year, then that tax burden can become pretty substantial. Now, next we have partnerships. Now, partnerships are pretty similar to sole traders. Okay, it's effectively a sole tradership, but it involves two or more people. So again, the pros here, right? It's pretty easy to set up. Pretty simple, straightforward. There's also some shared responsibility, right? Because it's the partnership and you might have two or more partners involved in the business, then you're going to have shared risks and responsibilities across those areas. The cons, however, here are that still there is unlimited liability. Like sole traders, the partners are going to be personally liable for business debts. And also, again, the taxation side. Again, profits are going to be shared based on the partnership agreement you're going to have, which might be 50-50 or it might be some other split, but you're going to be taxed on your share of the profits as personal income. So in a partnership, the partnership itself doesn't actually pay tax. It's the individual partners. And once you've been distributed your share of the profits, that's going to be subject to not only tax, but also class 2 and class 4 national insurance, just like the self-employed sole trader option. This structure can be beneficial for spreading the tax burden, but the unlimited liability here is a bit of a risk. Next, we're moving on to limited liability partnerships, or LLPs. Now, this structure offers some of the benefits of a partnership while also limiting the liability of the partners, right? So you see what we started to do was get that ease and flexibility, but we're starting to limit the liability. So the pros here are that limited liabilities. The partners are not personally liable for business debts. Okay. There's also good tax flexibility here. The profits are taxed as personal income, but the liability protection here is similar to that of a limited company, which we'll come on to in a minute. The cons, right? These are pretty complex. They're far more complex than a traditional partnership. They're much more costly to set up, and there's a number of things to certainly be aware of. They're far less common because of that as well, okay? Now, tax-wise is another bit of a con here. Partners still pay income tax and national insurance contributions on their share of the profits. Again, it's the same problem, right? If you're going over £50,000, then that's starting to really quite rack up, and it can be a bit of a con in relation to having an LLP set up. So with an LLP, you get the benefit of the limited liability, i.e. protection from the debt, but you still tax personally on your share of the profits. It's a good middle ground, right, for those wanting the personal protection without fully incorporating into a limited company. Which nicely brings us on to the limited company. So finally, we do have to get through to limited companies, yeah? And you've probably all heard of limited companies because it's one of the most common ways. Now, a limited company, right, is a completely separate legal entity from its owners. So therefore, it provides this real separation and therefore is the most comprehensive limited liability protection. Okay, so the pros here are that the owner's personal assets are protected. So your only liability is restricted, bar a few bizarre circumstances, but your liability is restricted to the level of capital that you put in order to start the business. So i.e. buying your shares and then maybe a loan that you might want to give to the company. It's also pretty good for tax efficiency. The profits are subject to corporation tax. Corporation tax is often lower than personal income tax rates, particularly as you start to go above the £50,000 level. So now you see where it all comes in. And then dividends can be a real tax efficient way to extract those profits from the business. Okay. In the previous episode, we talked about that combination of limited companies and having a salary and dividend combination to give you a good way of withdrawing your profits. That's where this comes in. Now, the cons here, right, is the complexity. There are more regulatory requirements for limited companies, and therefore there's much higher administration costs. Okay, so there's lots of stuff that you have to do each and every year in order to make sure that you're meeting all the requirements of running a limited company. Some of it accounting related, some of it admin related, but you need to be on top of all of those to make sure that you're staying legal. The other con is the profit distributions. Yes, corporation tax is lower than what income tax is, but in order to distribute that income out to the shareholders, you're going to have to pay dividends, and dividends are subject to additional tax. Now, those tax rates are often lower, in fact, considerably lower than what income tax rates are. So there's still a net benefit normally. So a limited company pays corporation tax on its profits. That's currently 19%, but it could be as high as 25% in terms of when your profits go over certain levels. And then shareholders can take dividends, which are then taxed at lower rates of income tax compared to if you were being self-employed. This dual level of taxation, though, can often result in overall tax liabilities that are much lower compared to sole traders and partnerships, especially if you are a higher earner, i.e. those above £50,000 of profits per partner. So single partner if you're just a sole trader, two partners looking for at least £100,000 worth of profits. That's where the real benefits kick in. So how do you make the right choice, right? There's so many complexities here. So here's some key points that you need to consider. First of all, your profit levels. Higher profits, i.e. those above £50,000 per partner, then you may benefit from the tax efficiencies of a limited company. Okay. If you want to consider liability, then you want to protect your personal assets, then an LLP or a limited company is definitely the route you want to be looking at. If you want to make sure that the admin capacity, the admin complexities and all of that are much, much lower, and the burden on you to be able to own and manage it yourself, then you may want to consider the partnership or the sole trader route. Okay. But naturally, as your business grows, you're probably going to want to start outsourcing those elements anyway, because it's about who, not how. Yeah, you certainly want to make sure you've got lots of people doing things for you. And therefore, it makes more sense that as you're moving up those profit levels, your admin capacity is probably, your capacity is going to go down, but therefore you're willing to outsource more of it. Okay. So in summary, right, there is no one size fits all answer. Typically, right? It's always the way with accounting and tax. The best structure does depend on your specific business circumstances and your goals and your specific personal circumstances as well. So consulting with a tax advisor or an accountant can really make sure that you get the proper tailored advice to help you make the best decision. I'd certainly recommend it. And if you're in doubt, drop me a message and I will try my best to help where I can. Thank you. Thanks so much for taking the time to join us for this episode today. We will continue to bring you great tips and tricks in future episodes. But if you can't wait until then you can always head over to our Facebook group and join the conversation with fellow business owners and entrepreneurs. Just search Accounting Tips and Tricks on Facebook or check out the show notes. Until next time.